Flashcard 4, examining the not later than and not earlier than entries between the regression line 10 in blue, the proxy for price, and the orange region, which is representing the dragon, or the 10-period Bollinger Band plus or minus a half. Because the Bollinger Band is based around a simple moving average, it's always going to lag the least squares moving average, or the moving regression line, which is more adaptive than a simple moving average. So it has the effect of a trailing stop set by a multiple of itself. So in the case of entering at X, this looks like a pocket re-entry. Perhaps the previous move was up, it pulled back and then resumed. It found support at the edge of the dragon and then resumed its upward move, so we buy it in the pocket. And then price goes up a certain distance and then starts to roll over, and the RL10 starts sloping down. The places where I can get out of this trade, 1 through 7 in red. But first let me go back and look at the typical structure of our trades. So if the RL10 goes below the belly of the dragon, or price goes below the belly of the dragon, we would treat that as an execution stop. For position sizing, I'm using some multiple of a frog box or a fraction of a frog box, such that I never take more than a 1R loss, and that when I take the trade at X, I have two of those position sizing stops. I have 2 units of risk for reasonable upward movement. So I have my 2-to-1 baked into the cake. Now it may be that my execution stop is only a 0.3 or a 0.4 R loss, which is fine. That just gives me a 0.6 or 0.7 cushion towards never violating my rule, never take more than a 1R loss. All other things being equal, if this pattern fails and price goes through my execution stop, that's the place where I must be considering as a not later than stop and reverse. Now maybe I stopped up here and maybe this is where I reversed my bias, but a price below this line is the price at which I am 100% certain that the opportunity represented in this trade is gone. Anything north of that, there was still some chance for it to find support and continue, and then the upward bias indicated by buying in the pocket is still valid. But maybe I don't need to get to 100% certainty to preserve capital. In fact, the further this falls, the less likely that it's going to resume and go. And then at position 4 is where I consider that to be 100% certain that we just invalidated the hypothesis of this trading experiment. So that's what 4 looks like and what it means to me. So I enter at X and it moves up a certain distance. The first place I'm thinking about by rule getting out is when the RL10 enters the dragon. Second position when the RL10 leaves the dragon. This is the RLx10 is kind of, or RLxD, regression line crossing the dragon, is my default exit position because that actually creates a pocket on the other side, and that's really where I'm thinking about stopping and getting short, because I'd like to get short between 2 and 4, because at 4 I'm 100% certain this thing is failing. I would actually like to be into the short position somewhere in here if I thought there was 2-to-1 to the downside or reason to believe in the collapse. So really 2 looks like my not earlier than entry, and 4 looks like my not later than entry. That's the belly of the dragon in this case, and the pocket of the dragon. Not earlier than, not later than, getting short on this downside trade. So per flashcard 2, what I'm trying to do is improve my retention of profits on these stepwise moves up the ladder. And so that's where I would consider exiting at 1 to get maximum preservation. And then if it takes off through the blue line, then I just re-enter. I don't have to worry about being wrong or right. It's just driven by price. So if my execution stop were here and it moves up into here, if I have not trailed, then to get out at 1, I call that a strike price, in which I've decided my purpose now is to strike fast and hard and to preserve the open profits. So I don't let the trailing stop take me out. I let the trailing stop work, and then when I feel a need to strike, I strike based on market conditions and my read and maybe the money that's open the amount of money that's in the open trade. So 2 is my default exit. 4 is a not later than. 3 I just represent as somewhere in between 2 and 4. I've drawn it as if it was actually a negative trade, and so I don't really like 3. I would like maybe a scratch over here. So 3 is somewhere between 2 and 4. In this case, to me, it's a negative. I've waited too long. I might as well just wait for 4 and then stop and reverse. To get out at 5 is about a minus 0.9. I've already lasted uh, way too long past the point where I was 100% certain this thing was failing. And now I'm just being stubborn and hopeful against all odds that it's going to find support here and then take off. So to stay in this position that long doesn't make sense based on the logic that the execution stop here is drawn at a place where I believe that the hypothesis is disproven. 6 is uh, really a horrible feeling to get in at X and then out at 6, just as the failure is bottoming, and it actually might be working. This getting out at 6 is just really harsh. But if you're not out by 6, you have to get out at 6, because if this fails, now the length of this leg is the length of the next leg down. 7 is just a horrible place to get out, because that's actually the place I should be getting in on the owl pattern or the pocket pattern or the RLxD. And now if I have gotten short at 2 or 4, 1 and 2 now become the places where, like up here, 1 and 2 are the places where I look to cover to sort of optimize the retention of profits. I'd like to be able to stop and reverse it too, but not later than 4 get back in, because what I did was I found the hump of the dragon or the hump of the RL10 and drawn my line across and picked one of those to be my not later than exit point. I usually prefer the hump of the dragon. And 4 is where I can get in. That is front running. 5 is sort of just as it breaches that line and taken off. This is where I expect it to pop. So if I'm getting in at 5, I feel like I'm chasing. So my preferred method here, enter at X, exit either at 1 or 2 if the short trade is indicated based on other market conditions and trade framing. And I can see 2 to 1. Then I'm short at 2 with an execution stop at the blue line. At 4, I'm ready to preserve, because this is where it found support before. So if it hesitates at 4, I'm going to cash that. If it gets through there, I want to exit somewhere at 5 or 6, but not later than 7, because now, based on the owl in the pocket, I'm looking to get long probably around position number 2, but not later than 4. If it's at 5, then I'm chasing. Anytime that I accelerate my stop to lock in a profit in order to, I'm going to trade off my need to feel certain for a need to preserve the maximum amount of profit from the open trade. And I call that a strike exit. So this is our analysis of different decision points for entering and exiting and stop and reversing in the regression line and dragon portion of the RLCO framework.